Today we have a webinar on IFRS updates, but previously we had a student webinar on the updates on the arrangement for examinations and examination readiness. Our presenter today is CPA Charles Lutimba. He's currently the Manager, Standards and Technical Support at the Institute of Certified Public Accountants of Uganda. He has vast knowledge in accounting, financial reporting, internal and external auditing, ethics, public financial management, integrated reporting, corporate governance, risk and management taxation. Charles has worked at the Institute of Certified Accountants for over 8 years. So I'm sure his knowledge will be of great value to us. He also holds qualifications in CPA, Certified Public Accountants of Uganda. He has a master's in business administration. He has a postgraduate diploma in tax and revenue administration. He holds a bachelor's of arts degree in education, and he's also having a bachelor's of law degree. Just as a reminder, if you have any questions on this webinar, kindly post your questions to the Q&A, not the chat. Remember, questions that will be responded to will be only those questions that will be in the Q&A, not in the chat. So, Charles, I request you to take over.
Thank you so much, Claire. A very good afternoon to you, ladies and gentlemen. It's indeed a very big pleasure to have this moment to chat with you, those of you who are aspiring to become or to join this honorable profession. I pray by the end of it all, we shall have picked something in as far as the theme or the topic for the day is concerned. I presume I am audible and heard well enough. In case there are any challenges, feel free to alert the chair, who will also alert me. What I'm going to take you through is simply an IFRS update. I want to pledge one thing, that with IFRS updates, I'll simply mention what has so far been considered, what amendments have so far come up, where are we heading in as far as the developments of the standards are concerned. We may not deeply get into the gymnastics of illustrations, computations, and the like of a student nature. So one take home you should pick from this webinar, at least today, is that I will highlight on where an amendment or an introduction has been made on a particular standard. And I pray that you take note of that and go and refer to it further with your tutors or even with your colleagues. So our agenda for today, just to respect the catchment. The catchment simply refers to the concerned parties, just to make sure you are the right person attending this webinar. We shall be making references to those papers. We shall have a brief background on the entire standard setting process, because it's pertinent and key as far as your learning is concerned. We look at developments around the full IFRSs. When I perused through the syllabus, I saw that there is some content expected of you in as far as the SME standard is concerned. We look at the international harmonization. The convergence project is very, very key in as far as the standards are concerned. And then drill also a little into integrated reporting, which aspect is kicking off and picking on in as far as the number of jurisdictions are concerned. The papers, particularly that every one of us, I believe, is aware of as lined up there, is just the integration paper that is missing, that automatically will bring together content that you have covered. With the paper one forming a basis, we shall not make much reference to paper one because that really introduces you just to the fundamentals, the key concepts in the profession, debit, credit, and other concepts that you studied at that level. But it is very important because it forms a basis for the other papers, paper 8, financial reporting, and then 14, public sector accounting, and then you move on to advanced financial reporting, which is paper 13. Our engagement today will largely drill around developments within paper 8, paper 13, and maybe the integration of knowledge. That is not to say that we've not had any developments around the public sector accounting and reporting, but it's simply to show that it's a paper that requires time and time for you to fully grasp the developments around there, but also the different improvements or amendments that are done in as far as public financial management is concerned. So to begin with, we have the IFRS Foundation. The IFRS Foundation forms or appoints and oversees the functioning of what we call the ISB. The ISB is the International Accounting Standards Board. The International Accounting Standards Board is the board that is in charge of publication of these different standards that you are seeing. And it issues a number of IFRSs, as we're going to see. But we also note that when for those of you who have been following these standards, particularly as far as the coding is concerned, you realize that we have what we call the International Accounting Standards, or what you refer to as in short as IASs. We're going to see that these IASs formed the basis, all of the origin of the standards, and then the entire flow of the profession from around 1973. So the ISs, as we're going to see, we're running from IAS 1, we have up to IAS 41. But like we're going to see, whereas they were running in that chronology, we are currently having about 24 active ones. A number of them have been replaced, repealed, and all merged with other standards. But what you need to notice that during the time of generation or publication of IASs, whenever a standard is issued, there are times when the language of the standard may not be clear for a particular industry. And as such, the board came up with what we call the Interpretations Committee. So during the time of the IASs, we used to have the Standards Interpretation Committee. And the Standards Interpretation Committee was producing what we call the SICs. SIC to mean SIC. So when you look at the standard, those of you who have had the chance to look at the Red Book, for example, you see we have, for example, SIC 1, SIC 2, and the others. Those were interpretations that were giving clarity on issued International Accounting Standards Board. But around 2001, when the board now stopped issuance of the IASs, and adopted issuance of what we call the International Financial Reporting Standards, what you commonly refer to as IFRS. The Interpretation Committee also changed from issuing SICs or SIC interpretations to now issuing what we call the IFRIC interpretations. So as we speak, we no longer have new SIC interpretations. We no longer have new IASs. I believe that is important for students. At the time we were studying, those issues used to confuse us. So when you hear of any new standard that comes up, it must be an IFRS. And when you hear of any new interpretation of a standard that comes up, it must be an IFRIC or International Financial Reporting Interpretations Committee agenda. So let no friend of yours lie to you out there in the discussions and tells you, you know what, have you heard of this new IAS, whatever code? We can no longer have new IASs, they are being phased out. What we can only have is a new IFRICs. So the standards, applicable standards are given in this format. On my left, or your left as you're facing the screen, you see the code. We have IS1, which deals with the presentation of financial statements. We have IS2, which is inventory. Both of these ones are active. We used to have IAS3, consolidation of financial statements, but now this was replaced and carried under IS 27 and 28. So actively, when we look at IS 1 to 10, we just have those 5 active standards: presentation of financial statements, inventory, cash flows, accounting policies, and then events. But the others like IS 3, 4, 5, 6, and 9, those ones have been replaced by the respective codes that I have included the other side. For standards between 11 and 20, we only have 4 active standards: IS 12, income tax, property, plant and equipment, employee benefits, and then government grants. And then when you look at 11, 13, 14, 17 leases, and 18, those ones have been transformed and changed respectively. From 20 to 30, the codes we still have as active: effects of changes in foreign exchange and borrowing costs, accounting and reporting of other BSs, and then the others up to hyperinflation economies. But business combinations has now been taken into IFRS 3. Accounting for investments is in parts are in 39 and 40. And then disclosure of financial statements of banks and similar financial institutions has now been taken into 7. Between 30 and 40, we have those active standards, about 8 active standards, including earnings per share and the rest. But the ones that have been replaced or repealed are 31, 35, and 39. So in brief, what I'm trying to connect is that some people have always wondered, why do we have IS1, IS2, and we don't have IS3? A simple response to that is that IS3 used to be there. It was just repealed and bundled in other standards, but they actually used to run from 1 up to 41, a time when the ISB stopped issuing them and now adopted the IFRSs. With IFRSs, currently we have them running from 1 to 17. The only IFRS that is up for replacement, though the effective date has been extended, is IFRS 4. Otherwise, because these are newer standards, they are all still active and applicable. So I pray that we move on to the new pronouncements. And these new pronouncements are those that are effective 1st January 2020 and beyond. There are some that are stretching up to 2023 as an effective date. And we shall endeavor to look at each and every item that is listed there, just to appreciate what may have changed as far as those standards are concerned. Let us begin with the conceptual framework for financial reporting. The conceptual framework for financial reporting, you will note that was first issued in 1989, and ever since it had not had any significant amendments until when in 2004, the Americans under the Financial Accounting Standards Board and UK under the International Accounting Standards Board agreed on the project of convergence and believed that creating or streamlining convergence, they needed to begin with this conceptual framework. From your studies, I am aware that you informed that the conceptual framework simply lays down key concepts that underlie preparation and presentation of financial statements, clearly spelling out the purpose for financial statements, but you are also informed that a conceptual framework is not an AFRS, it's not a standard per se, but also you need to note that since it forms the basis, it is not meant to conflict with any standards that are issued by the board. However, the amendments to the conceptual framework simply allude to the fact that there are instances when the board realizes some limited scope of conflict between the framework and the real standard. Someone may ask what then is the purpose of the framework. If we were speaking law, I would say the framework forms what we call the grand norm, the basis for all the other standards to take course. So if, for example, there is an aspect that is not provided for in any of the standards that are available, our rescue point will always be to run to this conceptual framework to find out what it says or how it guides on a particular matter. So it's a very important aspect, but like I said, it's not a standard per se. So in the revision of this framework, the new framework now has 8 independent chapters, and the chapters include chapter 1 is the objective of general purpose financial reporting. And this was the very first chapter that was completed by the two boards, the American board and the UK board. And it simply notes that the objective of general purpose financial reporting is to provide financial information about a reporting entity that is automatically useful to existing and potential investors, lenders, and other creditors in as far as making their decisions relating to the use of resources is concerned. Maybe what is new as far as the objective of general purpose financial reporting chapter is concerned is the fact that the chapter now stresses the fact that information can also help users to assess management stewardship in as far as the use of an entity's resources, economic resources is concerned. Chapter 2 deals with the qualitative characteristics of useful financial information. This has not heavily changed. We still uphold to the fundamental qualitative characteristics, which are automatically relevance and faithful representation, but also not forgetting enhancing qualitative characteristics, which include comparability, verifiability, timeliness, and many, many others. Those of you who might have started the course far away before, I think before 2004, remember the qualitative characteristics were I think over 6 or 8. But now these have been bundled into the fundamental qualitative characteristics and then the enhancing qualitative characteristics. I think that is a key component that we need to consider in as far as that chapter is concerned. The conceptual framework under the chapter of financial statements and the reporting entity now includes that element. The amendment is around the inclusion of the element of the reporting entity. But ideally, the financial statement simply gives the composition of the different items or different information that is expected to be included in financial statements. When we talk of assets, we talk of liabilities, and many others. But what is important, the new conceptual framework now defines what a reporting entity is. And it simply says it's an entity that is required or the one that chooses to prepare financial statements. And this entity could be a single entity, it could be part or portion of a single entity, or it could even be an amalgamation of entities. But what is important to stress, as far as reporting entity is concerned, the conceptual framework guides that entity does not necessarily need to be a legal entity. That is, I thought, key as far as this definition is concerned. Elements of financial statements, those of you who had mastered the elements, assets, liabilities, equity, income, expenses, and others, those ones have not changed as in listing, but there are some changes in as far as the definitions are concerned. And particularly, for example, there has been separation of definition of an economic resource to move the references to any future flows of economic benefits. And this has been done for both assets and liabilities. There has also been a change in as far as the economic resource is concerned. Remember, we have been talking of an asset being a resource. We simply talk of a resource, but the board thought that there was need to clarify, instead of simply referring to a resource, we now make particular reference to an economic resource for reasons that are well laid out in the basis of conclusion. Then as far as the definitions of assets and liabilities are concerned, there is no longer no reference to expected inflows or outflows. And these, I thought, are very important aspects that you may need to consider when you are referring to definition of these financial statement elements. The other chapter dealt with recognition and derecognition. Recognition ideally has not changed so much, but there is the introduction of a component of derecognition. And derecognition is simply, the conceptual framework is simply guiding that this is the removal of all or part of the recognized asset or liability from an entity's financial statement. It simply gives a number of, it also, the conceptual framework illustrates how the derecognition should be expected to be done. But ideally, we're simply saying that for one to derecognize an asset or a liability, they must have, first of all, had it on their financial statements. It even illustrates when an asset may be presumed to be derecognized and when a liability would be presumed to be recognized. The other chapter deals with measurement, and with measurement, they are simply giving a breadth of measurement bases that can be applicable. Remember, different standards have different measurement bases, ranging from cost, valuation, talk about value in use, and many others. So this tends to illustrate that. But what is very critical as far as the conceptual framework is concerned is that when management is deciding on which measurement base to select for a particular item, it's always pertinent that the qualitative characteristics, as we looked at them, are taken into consideration. The management basis you're carrying on, is it relevant? Does it faithfully represent information, and many, many other aspects that will be considered. Chapter 7, presentation and disclosure. Here the framework simply discusses the concepts that determine what information is included in the financial statement and how such information should be presented and disclosed. What is important to note when we get to the updates on materiality, we're going to see how the board is becoming critical on the way you sort the information, the way you present the information, the way you lay the information in a financial statement set. And then lastly, the chapter that deals with the concepts of capital and the capital maintenance. This largely did not change. It stayed as it was in the previous framework. The only reason that was given was that probably taking time on such a standard, rather such a chapter would have cost the board more and more time and would not have allowed the conceptual framework to be relayed at the time it was. Probably there will be discussions around the amendment of that particular chapter, and we shall await to see whatever would come about. The other development is around the definition of a business, and this particularly relates to business IFRS 3. What we are saying is that the board has amended the definition of a business, and it has clarified on the minimum requirements for something to amount for activities to amount to a business. It removes that aspect, the common aspect of assessment of whether market participants are capable of replacing any missing elements, but it gives other guidance to help entities to narrow down the assessment of whether an acquired set of activities or assets amount to a business, and hence introducing what we call the concentration test. The most important aspect as far as the business definition of a business is concerned is there are these aspects that it now narrows the definition of outputs and the business to focus on returns from selling goods and services. Those of you who are conversant with the definition, you will note that previously the standards used to define a business as an integrated set of activities and assets that are capable of being conducted and managed for the purpose of providing a return in the form of dividends, low cost, or other economic benefits. So they were defining, the output in form of a return, or low cost dividend, but now the new standard introduces the aspect of managing an integrated set of activities, all assets capable of being conducted and managed for purpose of providing goods or services. So the goods or service element is very important in the new definition. The definition also amends guidance on inputs, processes, and outputs. And ideally, what we're simply talking about is that the inputs should be in position to be processed in order for a set of activities or assets to generate what we call an output. We're going to see that illustration in the next slides, but it also clarifies on the minimum aspects of an input and a substantive process that together significantly contribute to the ability to create outputs. Ideally, the most fundamental aspects or changes here are the composition of what an acquired set of activities and assets is. What we are saying is that there must be an input. And an input, it could be a given set of workforce with a skill, a specific skill. And we are saying there must be a substantive process. We shall see that with a substantive process, we're simply talking about the ability to get the inputs, say the workforce with the skill, coupled with the different tools that you might have at their disposal. The two mixed together, they should be in position to significantly contribute to creation of an output. And that would compose what we refer to as a set of activities. The other important aspect, like I said, is a substantive process. The standard provides extensive guidance on what amounts to a substantive process. But as a guide, what we're simply saying is that for you to establish whether there has been work done on using some tool or something in order to create the other, you need to ask yourself whether is the acquired process critical to the ability to develop or convert an acquired input into output. If the answer is yes, then you need to look at the nature of this input. Do the inputs acquired include an organized workforce that is highly skilled, knowledgeable, experienced to perform the acquired process? If the answer is yes, then we need to find out whether these inputs acquired include other inputs. When you have a workforce, it must have what in production we call other cooperant factors. The other cooperant factors would be other tools that labor works with. Labor with the skill plus the other factors, other tools they use should be in position to create a process that at the end of it all amounts into generation of an output. So what is significant in this illustration is that where we have a process without inputs, for example, with a workforce that is not sufficiently skilled, that may not amount to a substantive process, because the aspect of value addition using a skill in conjunction with the tool to create something is very, very important. And then the last bit of this is the concentration test. And the concentration test simply alludes to the fact that there is substantially all of the fair value of the gross asset acquired concentrated in a single identifiable asset. If the fair value of the assets acquired can all be attached to one identifiable asset or similar group of assets, then that is likely not to be a business. Otherwise, if it's not, then that would be a business. The concentration test has been included, but it's an optional test just to enable or help entities that may find the detailed assessment of whether business has been occurred or not a little laborious and costly to apply. So it's not a mandatory test to apply, but whoever feels like applying may be free to apply it. The other amendment is around the IS 1 and the 8, in as far as the definition to materiality is concerned. You recognize that in accounting, the component of materiality is very, very important in determining our nature of work. I have included the old definition as it was, and then the new definition as it is proposed, for you to clearly see what has been amended. But ideally, what we're saying previously, we would say omissions or misstatements of items are material if they could individually or collectively influence the economic decisions that users make on the basis of financial statements. Now, because of the way that is crafted, later on we're going to talk about the harmonization or the convergence project. you will note that the UK under the ISB and the US under the FASB, the Financial Accounting Standards Board, are working on a convergence project. They are working on developing a whole suite of standards that will be applicable worldwide or in major economies of the world. You would realize that currently we've had little differences between these standards, given the fact that the UK-based standards, the IFRSs, are largely principle-based. They spell out a particular way of doing things, and at times they even go ahead and give you options. And as a user, depending on the jurisdiction, you may even choose to take whichever route you wish. But in the US, their standards are more of more legalistic, and a number of clauses that are provided for are more mandatory. So because of the convergence project, that is why you see a number of these developments. You will take a look at, for example, these amendments to materiality. In the old definition, we are saying omissions or misstatements of items are material if they could individually or collectively influence the economic decisions that users make. But we are saying that users make. Users are not clearly defined in the definition. And that gives an implication that any person, any user of financial statements would automatically be implied in that definition. But what does the conceptual framework say? Remember, the conceptual framework guides on who the main focus for preparation of general purpose financial statements is. So what now happens is that the new definition includes the word obscuring. The new definition shifts from could individually to could reasonably. And the reasoning was that where you say misstatements are material if they could influence, that tends to give a very onerous application because anything could influence. But now they go ahead and introduce could reasonably. So the reasonableness test is being used. And this is an aspect of legality, reasonable mind being introduced within these standards. And this simply shows an input from the US format and approach to the standard formation. But ideally, what we need to note as far as this definition is concerned are three aspects: obscuring. It is important that information is communicated in a way that it is intended. Incidentally, the standard does not define what obscuring is, but it guides on, it gives examples on when information may have been deemed to have been obscured. For example, where someone uses language regarding a material item, transaction or event, but the language is vague or unclear. If you have this included in the financial statement, we're saying it will be hiding some information, it will be obscuring some information. If you scatter information about the same topic all over the financial statements, it is obscuring information. If you inappropriately aggregate items that are not similar, or you disaggregate items that are similar, we are saying all this may amount to obscuring information, and therefore it may be, it may result into a material misinformation as far as materiality is concerned. The other one is could reasonably. I've talked about this, and then the users is changing from users to now primary users, just to define and have a focal point on who the primary users, who the focus person is concerned, and as a way to run away from greater liability and claim, where any user would come up and say, maybe I relied on these financial statements, even when they may not in the actual sense have been recognized as primary users. So the message we are picking on from here is that Introduction of obscuring elevates the importance of how information is communicated and organized in financial statement. So when you are compiling financial statements, the way you compile the orderliness and flow should be very, very important. The other aspect is about classification of liabilities as current and or non-current. There were a number of issues in as far as these classifications are concerned of liabilities as either being current or non-current. But the board came up with this amendment not as a per se changing the provisions of the standards, but as a way of drawing clarity on these classifications. And it simply asserts that to classify a liability as a non-current, an entity must have the right to defer the settlement of the liability for at least 12 months. But this right must have existed at the point of the reporting period. So the guidance is effective for periods beginning on or after January 2023. Another fundamental work has been around the IFRS 17. For those of you who may be working with insurance entities, you realize that on issuance of IFRS 4, it was issued not as a mandatory standard per se, but as a standard that provided guidance. And it came up with, it had a number of approaches, principles that entities, even in particular jurisdictions, would choose to take. Now, because of that, there was a great outcry out to, in the market, and the board therefore commenced on the work of coming up with the IFRS 17. This was issued in 2017, but what we need to note is that the insurance services industry is a very complex industry because a number of activities, called in the insurance contracts, heavily rely on what we call actuarial modeling techniques, but also on availability of substantive data. For someone to, for example, be in position to reliably estimate the amount of exposure, amount of risk they might have in a particular insurance contract, there is a great need of sufficient data that has been studied for quite some time, quite some long period. And we're saying, because of this, you realize that the sector is very sensitive when it comes to accounting. So the contracts, insurance contracts usually combine features or aspects of both a financial instrument and then a service contract. And what is also important to note is that insurance contracts generate cash flows with the substantial viability of a long period of time. You will realize that you may have a policy that runs for a given period of time, but we are saying for as long as the policy runs, the cash flows that are related to that particular contract will have to be recognized following a specific guidance and formula. So because of such features of component of financial instrument and service contract, the viability of cash flows, features of high use of actuarial estimation techniques, and many, many others. IFRS 17 decides to combine measurement of current cash flows with recognition of profit over the period and services that are provided under a contract. But also it presents insurance service results, clearly separating from insurance finance income or expenditures. And the standard now gives the preparer a leeway to come up with an accounting policy choice on whether to recognize all insurance finance income or expenses in profit or loss, and all to recognize that in the comprehensive income or CI. So in I think January this year, January 2020, there were some simple amendments that were made to this particular standard. And among the amendments was the issue of deferral of the effective date. You will recall that IFRS 17 was to be applicable, I think, in 2021. But because of the complexity, there is still debate. For example, when you read literature from the Americans, they seem to believe the standard is still too principle-based, and that is going to create divergence in the reporting. But the board thought that probably, since the market is still non-prepared, like we used to have, like we had with IFRS 9 when it came to data, storage of data, there are a number of insurance players that believe they are not well equipped with the data that will help them in the forecasting, estimating reliably, for example, the value of, there is what we call the incurred but non-reported risk, and many, many other aspects. So the complexity of the standard in this year, now coupled with the emergencies of COVID and others, the board felt it important that it needed to defer the effective date of insurance contract to now 2023, and automatically it also changed the exemption to IFRS 9 for insurance players to that period. However, the players that may wish to apply the standard may choose to do so because the early application is acceptable. But the only thing to note is that if you early apply IFRS 17, then you also early apply IFRS 9 if you are an insurance player. There were additional scope discussions, rather scope exclusions that were discussed, particularly in relation to loans and the credit cards. There was also an agreement on reduction of accounting mismatches of insurance, of reinsurances. You will note that in the insurance sector, losses or non-onerous contracts are usually used to be recognized immediately when covered by an insurance contract, but any corresponding gain would be recognized over the coverage period, the whole coverage period of the insurance contract. And you recognize a loss immediately, but the gain is spread over the insurance contract, was creating some sort of mismatch. So the board felt that it needed to come up and address this particular issue. And that is why at the January meeting, it was agreed that if in recognition of losses on an onerous contract at initial recognition, if you recognize them at initial recognition, then you need to also recognize the gain arising from reinsurance contract, provided that the reinsurance contract were recognized before or at the same time as the loss. So these aspects that are brought up just to draw clarity, but they don't substantively amend or change the provisions that are already included within the standard. There was also an issue on the simplified balance sheet presentation. You will recall that under IFRS 7, originally it required that groups of insurance contracts be separated and presented in asset and liability position. But you would note that doing this, a number of players complained on the need to have sophisticated IT gadgets, IT equipment that would enable them match up and link these particular presentations. Now what the board has chosen, the course it has chosen to take is insurance assets and liabilities can be separately presented, in the balance sheet using what we call the portfolio of insurance contracts instead of the group of insurance contracts. Other amendments that were agreed on are allocation of acquisition costs. There were also a number of transitional reliefs, for example, in relation to estimations used by insurances, and then the attribution of profit to service related to investment activities. These decisions, or right up around this, is available all over the ISP, the IFRS website, all over internet. You could have some time and read deeper into the amendments. But like I said, the board felt that they did not significantly amend the content of the standard, but simply updated or drew clearer some of these provisions. First time adoption, IFRS 1. The first time adoption, we are simply drawing a comparison between subsidiary and then the parent of that particular subsidiary. You will note that previously, when we had the parent earlier adopting IFRS, and then a subsidiary later on adopts IFRS, it was a requirement that the subsidiary prepares what we call two parallel sets of financial statements. A set of financial statements that was compliant with IFRS because the parent is, and then a set of financial statements that was using the gap that the subsidiary was using the framework that the subsidiary was using. But that seemed to be a little onerous and costly to subsidiaries, and the board believed that if, for example, the parent has been carrying on consolidation, then there was no need for a first-time adopter. A first-time adopter who is a subsidiary to prepare two parallel sets of financial statements. So the exemption rule that recognizes cumulative translation differences was also extended to subsidiary accounting. As far as IFRS 9 is concerned, there was also some amendment update around here, and this particularly related to fees in what we call the 10% test for the recognition of financial liabilities. You will recall that paragraph 3.3.2 of IFRS 9 requires an entity to recognize the original financial liability and recognize a new financial liability where there has been an exchange between an existing borrower and lender of debt with the substantially different terms, or where we've had a substantial modification of the terms of the financial liability. What this simply means is that imagine of an entity A who is a borrower from entity B who is now the lender. We are running with a liability that extends for, say, a certain period of time. But before the end of that specified period of time within the contract, we have a discussion and revisit the terms and conditions of the debt. So if we revisit the terms and conditions of the debt, the board is saying if the impact of the terms and conditions falls within 10% test rule, then you should recognize, you do recognize the old loan and recognize the new loan. The standard clearly specifies that substantially, if the discounted present value of the cash flows under the new terms, but using the original effective interest rate, is at least 10% different from the discounted present value of the remaining cash flows of the original financial liability, then you must you must de-recognize the old loan and then recognize the new loan. So what was confusing the public was the fees within the 10% test. And the board came up and clarified that the fees being referred to are simply the fees that are paid, but automatically less any fees that may be received. So that was the clarity that was introduced as far as the 10% test of de-recognizing a financial liability is concerned. There were some amendments under lease incentives, but this particularly related to the illustrative example 3. When you look at the examples given in example 3, the illustration given in example 3, the fact pattern or the illustration contained the reimbursement on leasehold improvements. But the standard had not clearly elaborated on whether this should have been considered as a lease incentive. Remember, in determining the right of use, you will compute a number of costs that are provided for, but you less any lease incentive. So this time you have leased an item, but in leasing an item, you have incurred a cost of improving that item. But you are improving the item on condition that there will be a reimbursement from the lessor. So the illustration, whereas it had included this aspect, it later on, it was realized that it seemed not to carry any meaning because it did not relate to, or it would not be included in what we call the lease incentives. So here, what the board simply did was to get to the illustration and cancel out that fact or that item of lease improvements. There was something as far as the IS 41 is concerned, and this was a taxation in fair value. This was also another simple amendment which arose from the fact that the board excludes taxation cash flows from calculation in one paragraph and then forgets to amend the same in another paragraph. So at the end of it all, it was causing confusion, but what it simply did was to totally remove any reference to include taxation cash flows when measuring a fair value. But when you read through the basis of opinion, the board also seems to justify this position in a way that it says it simply wanted to re-echo the position that is available within the IFRS 13, which ideally deals with the fair value, since such guidance is clearly provided for in that standard. And one way or the other, it was somehow trying to harmonize the standards. There are some research projects that are going on. Some are at the level of discussion papers, others are at the level of exposures, and these are some of them. When you look at the ISB calendar, there are expected dates of responses, and these are some of them that are being considered. Probably what is important to note is the aspects around extractive industries. This is an activity that as the East African Community Institute, we have also embarked on. We really want to see whether it's possible to come up with guidance, particularly in this extractive industry, since we are seeing and we just registered commendable growth in the performers and preparers of financials in this sector. Other projects include this discussion paper on subsidiaries that are SMEs, management commentary. Management commentary, for purposes of every one of us, simply refers, those of you who have looked at annual reports, there's always that discussion that follows a financial statement. You look at a report and you see a management discussing, let's say, about macroeconomics, management discussing about the performance, management discussing about human resource issues. So there is an exposure that is seeking to give guidance on what is expected within disclosures of management commentary. Their maintenance projects, we shall talk about the review of IFRS for SME, but ideally, these are maintenance projects. Maintenance projects simply refer to simple work being done either to align or to amplify some of these pronouncements, some of these standards, to give them a better appreciation and a faithful interpretation across the board. So those are some of the activities that are available with clear expected dates of commentary. Other maintenance projects are also here. Incidentally, whenever these requests for comment are published, we tend to reach out to members, to you students. So whenever you have a comment about an item that you wish either should be clarified, should be amplified, you don't think is applicable, feel free whenever such a call is passed to share with us, and then we shall relay that feeling or that comment to the standard setters. But those other activities that are available, they are agenda decisions. Now, what happens in the way of doing work, the ISB, like we said, sets a standard, say IFRS 1, IFRS this. But at times, because the standards are principle-based, they may at times not bring out a clear picture on treatment or application. So if you're in a jurisdiction, you say working with an entity and you think there is a inconsistency in application, or you think there is a clarity in application, you may demonstrate this by seeking for any interpretation of a particular paragraph or content of a standard. So when you submit, that is what will now form will inform the work of the interpretations committee, and therefore come up as IFRIC, the ones we talked about, the International Financial Reporting Standards Interpretation Committees. But there are times when you have raised an issue that does not call for total amendment of the standard. In such instances, the board may wish to simply give you an interpretation, and that interpretation turns into what we call an agenda decision. Imagine in Uganda, there is something we are all contesting about. We are saying we don't know how it should be applied. Let us do this. We're going to see some of these issues. So if you are not certain of how it should be done, you submit to these guys. We're saying you'll get an interpretation in form of an agenda decision. Whereas with the standards, the IFRS, ISAs, and their interpretations, the IFRICs and SICs, are mandatory as far as compliance is concerned. Jurisdictions have received agenda decisions differently. An agenda decision on a particular item, you will find in some jurisdiction it's taken as mandatory, whereas in other jurisdictions they have the opposite. I've said that these decisions come up as a result of contest amongst users. So these are some of the decisions that were passed since Jan, March, February, and then rather Jan, March, and April to June. But I will simply share a few. For example, the one on definition of a lease under a shipping arrangement, the one that was issued in January. What happened here, the question for interpretation was whether a specific type of shipping contract contains a lease or not. And according to the board, it indicated that this was raised by people who are engaged in transport. You go and lease out a ship for, say, a given period of time. You use it for whatever the contract spares to use it. Maintenance could be by the ship owner and others. So the question was whether as such a contract meets the definition of a lease. Remember, the definition of a lease as far as IFRS 16 is concerned, it talks of an identifiable, there has to be an identifiable asset. There has to be substantially all economic benefits available for use. And then the lessee must have the right to direct how and when or for what purpose to use the asset for. So in this definition of a lease in relation to a shipping contract, the board believed that the contract existed because the customer had the right to direct the use of the ship for the term of the contract, and therefore it satisfied all the requirements as provided for under IFRS 16. The other one was about 15, revenue from contracts with customers, training costs to fulfill a contract. Ideally, the case here was, should training costs that are incurred by a supplier that are necessary to be able to deliver a service to a customer and that are specifically reimbursable from the customer be recognized as a contract asset? You have your firm, you're hired out by a client to do a particular service. But for you to fully and efficiently manage the service, you believe you need to equip your staff with a certain skill. But we are saying, based on your contract, this skill, the expenditure on equipping, on training, is going to be reimbursed by the client. So the issue was whether such training contracts would fulfill to be a contract. So the board observed that instead the entity had to simply recognize the training costs to fulfill a contract as an expense when incurred. And this ideally clarified that such costs would simply form part of the expenses that would be charged to the supplier. Another item that was discussed, probably the one I can share with you lastly on this bit, is the agenda decision relating to revenue from contracts with customers, presentation of player transfer payment. Now, this arose from an issue as to whether a football club transferring a player recognizes the transfer payment as revenue under IFRS 15, or it simply needed to recognize gain or loss in applying IS 38. For those of you who love soccer, you will note that If, for example, a team, let's say, I will not say Man U, Arsenal, people will say I'm taking side. If a team bought a player, that player automatically will be considered as an asset to them. And what happens, this club will always have contractual control over the player via their registration right. The entity is therefore presumed to register or to recognize a costing card to obtain that registration right. We have bought Ronaldo onto our team. We have acquired the registration right. And we are saying we are buying Ronaldo not as Ronaldo the person, but Ronaldo as a skill. And therefore, as a team, what we're interested in is a skill in him. So the right we have over, the registration right we have over him is what we are carrying as our asset, our intangible asset as far as the IS38 is concerned. When Ronaldo is with us as an asset, we keep developing him, we keep servicing him, we keep allocating him matches and other aspects that keep a player in, to stay on form, if I could say. So we are saying that once we transfer, we sell Ronaldo, say to Juventus, should we recognize the transfer payment we receive from Juventus as revenue under IFRS 15, or we simply look at the gain or loss we have made on Ronaldo? That was the confusion in as far as this agenda decision was concerned. And what the board settled onto was that the registration right is always recorded as an intangible asset under IS38. And that once you transfer the player, you have relinquished this registration right to the other party, say Juventus in our case. And once you do that, then there was need for you to apply the derecognition requirements as required and provided for under the intangible asset standard IS38. So when you derecognize Ronaldo off your balance sheet, then you will need to measure whether you have gained or made a loss as a result of that transaction. And that loss or transaction that you make would automatically be recognized in profit and loss, profit or loss. So in conclusion, the board ruled that where a player is transferred to another team, it does not amount to revenue recognition, but it's simply an assessment of the gain or loss that is made on that particular transfer activity, which is the registration right or title you have on the player. So these are the agenda decisions. They seem to focus and address a particular aspect that may have occurred in a particular jurisdiction. I pray that you get some time and look at them. They would help in illustrating some of the hurdles or challenges that you may be having in appreciating the standards. The other aspect I thought we need to talk about is reporting under IFRS SMEs. We said that there is a comprehensive review of IFRS SMEs. Maybe what you need to note as a general knowledge as students is that this standard has been permitted in more than 80 countries and it's used all over the world. In Uganda, we adopted the SME standard, particularly for small and medium enterprises. When you look at our 2009 guidance on implementing IFRS SMEs, there are certain entities that are not supposed to use this guidance. If you're a bank, if you are a circle, if you are an entity that keeps assets in fiduciary capacity, you're an insurance broker, NGO, government, or you're an entity where government has, however minor interest, you will not be allowed to use this standard. But what is also important to note is that as students, this is general knowledge. In my interaction with some of you when we visit, say, places of work, particularly those of you who are in the audit firms, you tend to mix up reporting frameworks. When we talk about full IFRS, usually we're talking about the fully fledged standards. The ones we looked at, IS1, IS40, and then IFRS 1, IFRS 17. Those are the full IFRSs. That is a reporting framework that you can use, that you may apply. When we talk about IFRS SME, it is a shorter version of a reporting framework. So when at times we meet some of you and we say, which standard do you apply? Some of you mix them up and say, we apply both IFRS and full IFRS. What we're saying is you can only apply one at a go, either full or small. But what you can pick from here today is that there are some entities that are not allowed to use the small, for reasons that are automatic, because the small tends to put down a number of requirements. It doesn't have very onerous requirements. So we have a survey that we are running. I believe you might have seen this call in your inbox. There is a proposal to amend this IFRS SMEs. Remember, it was first published in 2009. Then there were some amendments made in 2015. But since then, we have not had any significant amendments to the standard. Yet we've had innovations, creation of new standards from the counterpart full IFRS. For example, IFRS 9 has come up, 15 has come up, 16 has come up, 17 is coming up, but nothing is being done this side. So the board felt that there was need to amend, but before it could amend, it needed to seek opinion from the users, from new people, and the survey enlists the expected responses, particularly in regard to alignment. How do you want the small SME standard to be aligned to the full SME, to the full IFRS? How do you want the items or as components of the full IFRS 9, the full IFRS 15, 16 to be embedded within the small standard? So we would be happy to get your commentary and discussion around this amendment. However, as far as your syllabus is concerned, this standard is examinable. You may need to look through it. We were dismayed to be informed that even though the standard is available, there are some of you who are not aware of the SMEs. The SME is a simple standard. Its chapters are referred to as sections, where we talk about IFRS 2, here we talk about section 2. So, but a number of provisions tend to mirror the provisions within the full standard. So I pray that you take time and look through this standard. When I perused through your syllabus, I noticed that you are required to have some knowledge on the international harmonization. And the international harmonization is simply the convergence project that I talked about. I said that if you recall the genesis of accounting, cross-border accounting, it was started by a few countries. And the reason was because during the era, we call it I think the merchant capital period, where entities that were operating, say, in the UK, felt that there was insufficient market and resources within UK and chose to grow branches cross-border. Now, when they started moving out of cross-border, out of their countries, they automatically necessitated having standards that they would make reference to, such that if I'm in the UK, the standard I apply should not be different from the one that is applied by my subsidiary in Uganda. That was the genesis of the convergency, and we believe at one point in time, we shall have a number of these standards cutting across, being applied in the UK and then the US. The first B is the Financial Accounting Standards Board, which is the UK board, rather US board, and then the ISB is the National Accounting Standards Board, which is the UK. This is the timeline for the convergency project. You will read through when the slides are shared with you. I also realized that there was a component of integrated reporting in your standard, and I thought we needed to update you with these resources. Integrated reporting, we're simply talking about reporting that is integrated, that is brought together. The world of stakeholders are moving away from focusing on financial reporting, balance sheet, profit or loss reporting. But now they want to see corporate governance. How are you responsive? Sustainability reporting. How are you responsive? Community engagement, corporate social responsibility, risk management, and other aspects. These are the demands from different regulators, different stakeholders, and hence they need to come up with integrated reports. So just to draw to your attention, we've had building consensus towards a global system. There is that report. You may need to have time to read through it. You may need to look at preparing an integrated report, a status guide, which is provided by the Integrated Reporting Committee of South Africa. It can be accessed there. IMF has also released a report urging that investors and equity markets need to have a response to growing risk of financial losses associated with global temperatures. The Climate Disclosure Standards Board has released a report on falling short, and they simply estimate the importance of having climate-related disclosures within Europe's 50 listed companies. The Global Reporting Initiative, which is one of the reporting framework being used by some entities, even here in Uganda, also introduced a new standard, the 306 West 2020 standard, and it simply requires entities to report on, to have clear disclosures on waste, disclosures on waste management, and then how they are polluting, how they are managing and containing waste. There is a report on SDGs. There is another report on corporate reporting to strengthen sustainability development goals. You will note that, remember, accountants are dubbed as revolving. So for you to be revolving, you need to embrace some of these reporting aspects. If you are to assign the role of integrated reporting to any other profession, you may not pick much merits from it. Why? Because really integrated reporting is going to encompass a number of facets, including financial, but also others. So what we're simply communicating is that we need to begin thinking, running away from solitary financial statement disclosures alone to now a more broader wide financial reporting. Basel Committee on Banking Supervision has something, and the Japanese also have something on the environment, social and governance disclosures. And then the ISB, International Accounting and rather Auditing and Accounting Standards Board came up with extended external reporting assurance. And all these deal with an aspect of integrated reporting. Developments in Africa is that a number of African countries are now coming up with the integrated reporting committees, national committees, to spearhead embracing this aspect of integrated reporting. You may be interested in finding out what has so far been done as far as Uganda is concerned. I believe you heard about our financial reporting awards. The awards are hinged on integrated reporting. When you look at the assessment, we really take that holistic approach to assessing a report. We simply don't look at your balance sheet, profit or loss, but we look at also other disclosures in the case of governance, risk management, and many, many others. But the Institute has also continued carrying on what we call continuous professional development, particularly on integrated reporting. I am aware, I think tomorrow we have an integrated reporting seminar, and this is geared towards enriching you, the accountants, to be you people in the profession with the knowledge on integrated reporting. We have done a number of resources on integrated thinking and reporting. We have included these aspects in the CPS syllabus. The syllabus is under review. You will see more entry of content around integrated reporting. Why? Simply because we want, if you move out there, you should be someone that is fully stocked. Then we also continuously participate in the Africa Integrated Reporting Council meeting. We go as observers. And last year, 2019 report, ICPAU came up with a model integrated reporting, integrated report. You could look at that report to have a feel of what is expected of an integrated reporting. But also lastly, we had planned to launch the Uganda Integrated Reporting Committee, but given the circumstances, we were unable to meet with the parties that we had attracted. This is something that we are going to keep, we shall continue considering probably by the end of this year, before the end of this year. As I conclude, I need to mention that I've not made any references to COVID-related developments. You will note that a number of literature has been issued around the COVID-19 and accounting. But good enough, when you visit our website, we also design the frequently asked questions, and it has components of COVID-19 and financial reporting issues. You may make reference to that. But we also issued a guidance for auditors. It also has components of COVID and then aspects of financial reporting. Ideally, looking at subsequent events, going concern, estimates, IFRS 9, estimation, fair valuation, inventory, and many, many others. So I will simply request that you visit the sites and then have a feel. And then lastly, because this is a students' forum, I wish to also draw attention to these books for resources. You already have these books here. This is an IFRS book. It looks like this, the red volume. And this red volume will have the standards that we've been talking about, but it usually includes the standards that are applicable from 1st January of the day they are, of the day it is, of the day of the year it is published, but it will omit any standards that have been withdrawn or that are going to be replaced. Then there is what we call the green volume. The color is green. This green volume is usually issued in July and will only include standards that are issued by 1st July, the year it is issued, irrespective of the effective dates. There is another one which looks like this, but with a blue color. I don't know where I put it. But that with blue color will only have standards effective that year of issue. So if you see the one with the blue and has 2020, it will only have standards that are effective 1st January 2020. I thought as students we needed to distinguish these for us not to blunder when we get into offices there, you find a blue book and then you say, this is for lawyers, this is the blue, green, and the red are all accountants' books, but they have standards with the different commencement periods. Thank you so much. I hand over back to my chair.
Thank you, Charles. Thank you for the wonderful presentation. You've really educated us on the updates and also the value of integrated reporting. We are now going to have a brief session of questions and answers. So Charles, you're going to just go into the Q&A and respond to their questions.
Okay, thank you so much. I will quickly go through this.
A Q&A.
Q&A, yes, sure. What is the significant difference between IAS and IFRSs? I have said IAS were the original standards issued. They were running from 1 up to 41. But since 2001, the board stopped issuing those standards and it started issuing IFRS. So you will never see a new IAS. You will keep seeing them being phased out, but continue seeing IFRSs. That is why we are having IFRS 1, 2, 3. We are now at 17. Maybe in 20 or 23rd or 20 what we may get to IFRS 40. But what is significant to note about the development of this standard is that the board incidentally had put hold to launch of any new standard. I think that break was supposed to take 2 years. The board had not anticipated the COVID occurrence, I believe, but it had put a break. And the reason the board was giving was that it had issued out very key but complex standards. Remember, IFRS 9 is following 15, is following 16. So that is why it had issued that break. But I think there will be more will be issued. Somebody is wondering, as we keep updating on IFRS, keep updating us on CPA exams. This one is yours, Chair.
For that question, what I could say is previously we had the student engagement still online. We had a webinar on updates, on arrangements to do with examinations and examination readiness. And that webinar will be forwarded, I think, to you via your mails. But that issue was already addressed in the previous webinar.
Okay, thank you. Then there was someone talking about presentations of inventories. I think presentations are going to be sent. That one has been recorded by the chair. Can we access the standards from ICPAU websites? The standards are copyrighted, and what I can only confirm is that we have a landing page. I think it's called a landing page for IFRS for SME modules. But incidentally, you can access the unaccompanied, we call them unaccompanied standards on the IFRS website. The unaccompanied standards, you will be in position to view the standard itself, but you will not be in position to view the illustrations and the basis of conclusion. So I think that could be that could be a start. Then there was a Claire, probably just answer, will the change in standard affect the ongoing syllabus and coming examinations? Chair?
Definitely, we all know that the examinations we have lately are all to do with application. So, and the updates are in line with the application. So I'm sure those amendments will also be part of the examinations. So let us really critically look out for them.
Okay, thank you, Chair. Fred seeks that we throw more light on the 10% rule under IFRS 9. I said that when you look at paragraph 3.3.2 of IFRS 9, requires an entity to de-recognize the original financial liability and recognize a new financial liability when there is an exchange between an existing borrower and lender of debt with substantially different terms. What we are saying is that you have been running a debt, you have a loan, but before the expire of the loan term, there is substantial change in the conditions, the terms and conditions. And what we are saying is that if the terms substantially are different, for example, where the discounted present value of the cash flows under the new terms using the original effective interest rate is at least 10%, you will need to compare the discounted present value of the cash flows of the new terms using the original effective interest rate, compare it with the discounted present value of the remaining cash flows of the original financial liability. So when you compare and the difference between the new terms and the remaining term is at least 10%, then you will have to de-recognize the old loan and recognize the new loan. But I said what was bothering people was the fees that should be considered in the 10% rule, and that is what was defined as any fees paid less any fees that are received by the lender. Integrated reporting, how does it differ substantially from IS1 reporting requirements? Remember, IS1 is financial, presentation of financial statements, presentation of financial. You are presenting financial. But integrated reporting looks at financial, looks at human, looks at social, looks at environmental, looks at governance, looks at risk, looks at. So integrated reporting somehow embraces. So what he's saying is get your IS1 requirements and add on the other what the IWSP is terming as the extended reporting. I think can ICPAU come up with an annual publication on the amendments of IS and the enterprise and when they go. Okay, that is a nice suggestion. We shall endeavor to do that. Will these amendments be applicable in the next immediate exams? I think, Claire, you need to assure people it may not be now, but later on when the syllabus considers that.
Normally for Charles,
yes.
Normally for the updates, for as long as the effective date has been, it's past the effective date, let them expect them. That's how it works.
Okay. I think you have heard Johnson. When can one access the model integrated reporting? I didn't say model. ICPAU does not have a model. We still use the general framework developed by the Integrated Reporting Council. But what we did as ICPAU is to come up with a model annual report. A model annual report. I think the annual report is available on the website. The report for 2019 was structured around the integrated reporting. Is it possible to update the website with the tax amendments on this is a nice one, James. What we have resolved as standards and technical standards and regulation is to publish and make available on the website all commentary letters and such amendments like you're talking about. So when you visit the website, we should be having some comments we relay, be it on tax amendments, be it on exposures. They should be available under the technical folder. Can I do my internship after the course or before I finish the CPA course when the time is past? Is Ambrose online?
Ambrose,
Yes,
we need you for clarity. Can I do my internship after the course or before I finish CPA course? When the time is past for the internship, something like that. That question.
Yes, you can do the internship as soon as you start your CPA course. And it is much better because it is believed that as you do the course, you are also acquiring the related skills, the related experience. And then you are acquiring to document that experience. And as you are aware, we have an online portal. I know when you look to your account, you are able to see a blue statement that you are eligible for that experience training. So please click on it, apply. With the mentor, you have to look for a person who is either your supervisor at the workplace or any other person, but who is a member of the institute. And then he or she gives you the reference number, then you are able to apply for that program. So currently we're encouraging all students to document the experience. And as soon as you finish your course, then you are able to call yourself a certified public accountant. In the future, if you finish CPA course without documenting your experience or without relevant experience, then you will not be called a CPA. Then you have your qualification. Yeah. Thank you so much, Charlie. I hope I have answered.
Okay, thank you, Ambrose. Geoffrey wanted to know, can a country or board make adjustments in a standard when it is not from ISB? Now, I don't know what is known from ISB. When a standard is passed, that is why we're saying the standards are principle-based. Where a standard is passed and it has, for example, options or alternatives on a particular treatment, as a jurisdiction, you may choose to declare a particular aspect as applicable to your jurisdiction. So you can make an adjustment where there are multiple provisions within the standard. But what you need to note is that for you to declare standards, rather financials being fully compliant with IFRS, they need to comply with all IFRS. So your adjustment may not be may not introduce a significant change in the standard. But what we have seen with the jurisdictions is that even when we have the ISB declaring particular standards, say IFRSs, what jurisdictions are doing is just to get that standard and they transplant it into whatever nomenclature that applies to their particular jurisdiction and come up with something that mirrors this with probably a possible drop of particular assumptions that can be honest. The last one, my chair, the last one is how can we assess when to apply full IFRS standard or IFRS SM in terms of corporate level reporting? Assessing that, like I said, full IFRS can be applied by anyone, anybody, any entity. What you need to note is for you to apply IFRS SME, you must fall within you must fall out of the scoping. There are entities, whereas we can all apply IFRS full, there are entities that are not allowed to apply IFRS for SMEs. So SME standard is really for small one. If you're a bank, you cannot apply SME. If you're an insurance, you cannot apply. But if you are a small entity, entity along Kampala Road and you think full IFRS works for you, you are free. But if you're a bank, you have no choice, you have to go full. The last one, in the field working, do I need to do? That is the Ambrose's chair. I think I'm done with the issues that have been raised.
Okay, maybe Ambrose, you could respond to Bright. There's that question from Bright.
Yes, thank you so much, Bright. Bright, you're asking suppose you're working. Do you need to do your practical? Do you need to do practical training? Yes, you already doing practical training. But what this institute and the accountants association, and by the all over the world, this is now a requirement. What the accountants association requires you to do is to document that experience. Good enough training in the field. So what you do, go to your account and apply for practical experience training program, document that experience in that online. And then they are 7 years of training. Out of those, we need only 3. One of them is financial reporting, which is CPHR was talking about. The other one is the auditing. Another one is taxation, financial management, ICPAU, and many others. So, apply for training under the name of the institute, out there, and then document that experience. So the answer is yes, you want to get practical training, but document it. Then when you are done with your CPA course, then you are able to be called CPA. And you can go and defend your copy. Yeah, thank you.
Thank you, Ambrose. Thank you, Charles, for the wonderful presentation and for the way you've really approached those questions. I'm sure those who have asked are really satisfied with the reaction they got from you. For students who did not attend the previous webinar on preparedness, exam preparedness, and update on the arrangement of examinations, our tentative dates as per PAEB, 23rd to 27th of November 2020 or early December 2020. I still encourage students to, if you have queries of any nature, to visit our website. Just send those queries through students@icpau.co.ug. Otherwise, thank you very much, and let us be on the lookout. We have another student engagement session on the 18th of August, 2020. So members, Please be on the lookout for the next webinar that we'll be having. Thank you, Charles. Thank you, Ambrose. And thank you for those who have attended this webinar.
Thank you.
I wish you well.